You have blamed your strategy. You have blamed your broker. You have blamed the market. You have blamed bad luck, bad timing, bad signals, and bad setups. But there is one thing you have never blamed. One thing so close to you, so deeply embedded in your daily experience, that the idea of it being the problem has probably never seriously crossed your mind. Your brain. Not your knowledge, not your discipline, not your emotions, though those are symptoms. The brain itself, the 3-pound organ sitting inside your skull that processes every chart you look at, makes every trading decision you execute, and interprets every gain and loss you experience. That brain, the one you have trusted your entire life, the one that got you through school, and work, and relationships, and every challenge you have ever faced, is catastrophically, structurally, biologically unsuited for trading financial markets. This is not an insult. It is not a criticism of your intelligence. It is a scientific fact. And understanding it, truly, deeply understanding it, is the single most important step you can take toward becoming a consistently profitable trader. Because you cannot fix a problem you do not understand. And you cannot understand this problem until you see exactly what your brain is doing to you, why it is doing it, and what you can do to stop it. That is what this article is going to give you. Part 1. How your brain was built, and why trading breaks it. The human brain evolved over hundreds of thousands of years to solve a very specific set of problems. How do I find food? How do I avoid predators? How do I navigate social hierarchies? How do I survive today so I can survive tomorrow? These are the problems that shaped your neural architecture. Every cognitive bias, every emotional response, every automatic mental shortcut your brain uses. All of it was designed by evolution to solve these ancient survival problems. Financial markets did not exist during this evolutionary process. The concept of buying and selling abstract instruments that represent fractional ownership of businesses or speculating on the future price of currency pairs is, in evolutionary terms, approximately 5 minutes old. Your brain has not adapted to this environment. It is running ancient software on a completely new operating system, and the result is a systematic, predictable set of cognitive failures that cost traders billions of dollars every single year. Here is the critical insight. These failures are not random. They are not personal weaknesses. They are universal, hardwired features of human cognition that affect every trader on Earth, from the complete beginner to the 20-year professional. Understanding them is your only weapon against them. So let's go through every single one. Brain failure. #1. Loss aversion. Why losses feel like physical pain. In the 1970s, psychologists Daniel Kahneman and Amos Tversky made a discovery that would eventually win Nobel Prize and change the way we understand human decision-making. They found that the psychological pain of losing a given amount of money is approximately twice as powerful as the pleasure of gaining the same amount. Losing $100 feels, emotionally, like losing $200 worth of psychological well-being. Gaining $100 provides only half the emotional uplift that losing $100 destroys. This is called loss aversion. And in trading, it creates a specific, devastating pattern of behavior that you have almost certainly experienced, possibly today. The pattern looks like this. You enter a trade, it immediately moves against you by 10 pips. The loss aversion response activates. Your brain begins generating intense psychological discomfort, a discomfort disproportionate to the actual financial significance of 10 pips. To end this discomfort, your brain generates one overwhelming impulse. Close the trade. End the pain. Make the red number disappear. But closing too early means taking a loss that has not reached your stop. It means cutting a trade that may have been about to turn in your favor. It means letting your brain's pain avoidance circuitry override the systematic, logical decision you made when you entered. And on the other side of the equation, when a trade is in profit, loss aversion creates the opposite problem. The moment a trade shows green, your brain becomes terrified of losing that profit. Take it now, it screams. Close it before it disappears. So you exit early, before your target, before the logical exit point your system defined. You take a small win when your system was designed to capture a large one. The net result of loss aversion in trading. Losses run longer than they should, and winners close earlier than they should. Your average loss becomes larger than your average win. Over hundreds of trades, this asymmetry is mathematically fatal. How to fix it? Automate your exits. Set your stop loss and your take profit as hard orders in your platform before you step away from the trade. Remove the ability to make discretionary exit decisions once you are in a position. When the trade is open, your loss-averse brain is in control. Before the trade, when you are calm, analytical, and unemotional, your rational mind is in control. Lock in the rational mind's decisions before the emotional mind takes over. This single change, automating exits, eliminates the primary mechanism through which loss, aversion, destroys trading accounts. Brain failure, #2. The gambler's fallacy. Why your brain sees patterns that do not exist. Imagine flipping a fair coin. It lands on heads 5 times in a row. What does your brain tell you the next flip will be? Tails, right? It's due. The sequence has been so heavily weighted toward heads that a correction must be coming. This feeling, this absolute certainty, is wrong. The probability of tails on the next flip is exactly 50%. It has always been 50%. The coin has no memory. Each flip is completely independent of every flip before it. This is the gambler's fallacy, the false belief that independent random events are connected, that a series of outcomes in one direction increases the probability of an outcome in the other direction. In trading, this fallacy is everywhere, and it costs an enormous amount of money. After 3 consecutive losing trades, your brain tells you the next trade is due to win. This false confidence leads to oversized positions, poor setups taken prematurely, and the dangerous belief that you are owed a winner. After 3 consecutive winning trades, your brain tells you you are on a hot streak, that your judgment is sharper than usual, that the market is aligned with your analysis. This leads to the same oversized positions and the same eventual disaster. Markets are not coins. They are not perfectly random, but the principle holds. Your recent performance has almost zero predictive value for your next trade. Each trade should be evaluated entirely on its own merit, with the same position size, the same risk parameters, and the same emotional neutrality. How to fix it? Implement a fixed position sizing rule that does not vary based on recent results. Whether you have just won 5 trades in a row or lost 5 trades in a row, your risk per trade is exactly 1 to 2% of your account. Not more because you are confident, not less because you are scared. The same. Every time, this rule removes the gambler's fallacy from your position sizing decisions entirely. It forces your trading behavior to be driven by your system, not by the irrational patterns your brain is imposing on recent results. Brain failure, #3. Confirmation bias. Why you only see what you want to see. Your brain receives. Brain 3 in 11 million bits of information per second through your sensory organs. It consciously processes approximately 40. The gap between 11 million and 40 is filled by your brain's filtering systems, automatic, unconscious processes that decide what information reaches your awareness and what gets discarded before you ever know it existed. One of the most powerful filtering biases is confirmation bias, the tendency to unconsciously elevate information that confirms your existing beliefs and suppress information that contradicts them. In trading, this creates a specific and financially devastating problem. The moment you decide you want to buy an asset, before you have even opened a chart, your brain begins filtering. It notices the bullish signals. It highlights the positive news. It finds the moving average that is trending in the right direction and gives it extra weight, your analysis. Simultaneously, it minimizes the bearish signals. It discounts the contrary evidence. It finds logical-sounding reasons to dismiss the information that does not support your thesis. By the time you complete your analysis, you are convinced the trade is sound. You have found 6 reasons to buy and only 2 reasons not to. You feel confident and well-researched. What actually happened? Your brain selected 6 bullish signals from the available evidence and suppressed 6 equally valid bearish ones. Your analysis was not objective. It was a confirmation exercise, dressed up as research. How to fix it. Develop what professional traders call the devil's advocate pre-trade routine. Before entering any trade, spend a mandatory 2 minutes doing the following. Assume the trade will lose, and build the strongest possible case for why. Not a perfunctory, well, it might go down. A genuine, committed, aggressive argument for the opposite side. What would have to be true for this trade to fail? What bearish signals am I discounting? If I were short this asset right now, what would be my justification? If you cannot build a compelling case against the trade, if the bearish argument, genuinely, seems weaker after honest examination, proceed with confidence. Your analysis has survived a real stress test. If the bearish case is actually quite strong, if you find significant contrary evidence once, you deliberately look for it, step back. Your confirmation bias was driving. The trade does not deserve your capital. Brain failure #4. Recency bias. Why recent events dominate your judgment. Your brain gives disproportionate weight to recent events when making predictions about the future. This made perfect evolutionary sense. In a survival environment, recent information is the most relevant information. The predator you saw yesterday is more dangerous than the one you heard about a month ago. The berry patch that was fruitful last week is more likely to be fruitful this week than one you found last year. In trading, recency bias creates predictable and expensive errors. After a market has been trending upward for several weeks, your brain begins to extrapolate. It will keep going up. The recent trend feels permanent. The idea of a reversal seems unlikely, not because the analysis supports this, but because the recent experience of an uptrend has dominated your mental model of the market. This is why retail traders consistently buy at the top of rallies and sell at the bottom of sell-offs. The top of a rally is the moment when the recency of upward movement is most strongly embedded in collective psychology. The bottom of a sell-off is when the recency of downward movement is most overwhelming. Both moments represent the worst possible time to act in those directions, but recency bias makes them feel like the most natural times to act. How to fix it? Deliberately extend your analytical time frame. When assessing any market condition, force yourself to look at a time frame significantly longer than your trading time frame. If you trade on the 4-hour chart, open the weekly chart and assess the structural context before making any decision. If you trade on the daily chart, open the monthly. The longer time frame provides context that neutralizes the distorting effect of recent, short-term movements. It places the current market condition within its full historical context, making it significantly harder for recency bias to create a distorted picture of what is actually happening. Brain failure #5. The sunk cost fallacy. Why you hold losing trades too long. You are in a trade. It is losing. Significantly. Your rational mind knows the trade has failed. The setup that justified the entry no longer exists. The price has moved against you beyond any reasonable expectation of recovery. The correct action is clear. Close the trade, take the loss, move on. But you cannot, because you have already lost $300 on this trade, and closing it means that $300 is real, permanent, and gone. As long as the trade is open, there is a chance, however small, of recovery, and your brain cannot let go of what has already been invested. This is the sunk cost fallacy, the irrational tendency to continue investing in something because of resources already committed, rather than because of the future prospects it offers. Economically, the $300 you have already lost is irrelevant to the decision of whether to hold or no, close the trade. What matters is only the future probability distribution of outcomes, and in a trade that has moved significantly against your thesis, that distribution is almost always negative. But your brain does not think economically. It thinks emotionally, and emotionally, closing the trade feels like losing $300. Holding it feels like preserving the possibility of getting that $300 back. So you hold, and the trade continues against you. The $300 becomes $500. The $500 becomes $800. And each step of the way, the sunk cost deepens, making it psychologically harder to close. even as the rational case for closing becomes overwhelmingly clear. How to fix it? When evaluating an open losing trade, ask yourself one question only. If I had no position in this market right now, if I were starting fresh with a clean slate, would I enter this trade at the current price, in the current direction, at the current position size? If the answer is no, close it. The sunk cost is irrelevant. What matters is what this trade offers from this moment forward. And if you would not enter it fresh, you should not be holding it now. This reframing removes the sunk cost from the equation entirely. It forces you to evaluate the trade on its future merits, which is the only thing that actually matters. Brain failure #6. Overconfidence bias. The success that kills you. After a period of winning trades, something happens in the brain. The neural pathways associated with your recent trading decisions, the analysis, the entries, the exits, are reinforced by the positive feedback of profit. Your brain begins to associate your judgment with success. Confidence builds. Then, almost imperceptibly, confidence crosses a line and becomes something more dangerous. Certainty. Overconfidence bias is the systematic tendency to overestimate the accuracy of our own judgments. And in trading, it is responsible for some of the most catastrophic single-trade losses that traders ever experience. Overconfidence manifests in trading through one primary behavior: position sizing that exceeds what the system allows. This setup is so clear. I have never been more certain. I am going to size up, just this once, because this trade is as close to guaranteed as anything I have ever seen. The market does not share your certainty. It does not reward confidence. It does not acknowledge the quality of your analysis. It simply moves. And when it moves against an oversized position, the damage is not proportional. It is catastrophic. One overconfident trade can erase weeks of disciplined, systematic gains. And the psychological damage, the shattered confidence, the desperate need to recover, the subsequent emotional trading, can extend the damage for months. How to fix it? Treat your position sizing rules as sacred, not guidelines, not suggestions, rules. Fixed, non-negotiable, inviolable rules that apply equally to every trade, regardless of how certain you feel. The more certain you feel, the more carefully you should examine that certainty. Because the feeling of absolute certainty in trading is not a signal that the trade will work. It is a warning sign that overconfidence bias has been activated, and that your position sizing is about to compromise your account. The best traders are not the most confident. They are the most consistent. And consistency requires treating the most obvious-looking trade with exactly the same risk, discipline, as the most uncertain one. The complete brain rewiring system. You now understand every major way your brain works against you in trading. Here is the complete system to rewire it. Fix loss aversion. Automate your exits. Set stop losses and take profits as hard orders before you step away from the trade. Remove the emotional exit decision entirely. Fix the gambler's fallacy. Fixed position sizing. 1-2% risk per trade. Always. Regardless of recent results. No exceptions. Fix confirmation bias. Devil's advocate routine before every trade. 2 minutes building the strongest possible case against your position. Enter only if the bearish case genuinely fails. Fix recency bias. Always analyze a time frame significantly higher than your trading. Time frame before making any decision. Context eliminates distortion. Fix the sunk cost fallacy. When evaluating a losing trade, ask only, would I enter this trade fresh, right now, at current prices? If no, close it immediately. Fix overconfidence bias. Treat position sizing rules as sacred. The more certain you feel, the more carefully you examine that certainty. Conclusion. The trader. Your brain does not want you to be the brain you were born with, is an extraordinary instrument. It has solved problems, built relationships, navigated complexity, and achieved things that no other organism on Earth is capable of. But it was not built for trading, and pretending otherwise Continuing to trust it blindly in an environment it was never designed for is the most expensive mistake a trader can make. The traders who consistently profit are not smarter than you. They are not more talented. They are not luckier. They have simply done what you are now equipped to do. They have identified exactly how their brain works against them, built systems to neutralize those failures, and developed the discipline to follow those systems even when every instinct screams otherwise. Your brain is not your enemy. It is simply a tool, an extraordinary tool, that needs to be used correctly for the task at hand. Now you know how to use it. Now go trade like someone whose brain works for them. Drop a comment. Which of these 6 brain failures hits closest to home for you right now? Be honest. Your answer might be the breakthrough someone else needs. That the investor's chief problem, and even his worst enemy, is likely to be himself. Benjamin Graham.